9 o'clock on the 20th of June. Let me go ahead and get the risk disclaimer up. Let's begin. We understand there's risk in trading. Please and always use trade capital only. Do not trade with money you cannot afford to lose. Whether trading stocks, options, futures, forex, cryptos, you know the deal and you know the risks. All right, just getting logged in to make sure everything's coming through loud and clear. If so, type in wire yes for me. Let's get into the charts. Hey everybody, happy Monday. Let's begin. We will kick things off with where everything is at year to date. The Nasdaq's down 30.98%, S&P down 22.9%, officially in bear market territory for both. S&P is closing below that 20% level. We're looking at probably close to 30% on the S&P as far as pre-COVID highs, looking at correction levels. The Fed didn't do any favors to the market last week. Inflation numbers the week before that, none of which have given the markets any confidence to find some bottoms. So we're even creeping up on bear market territory on the Dow, 17.75% to the downside. 10-year note, we've seen it as high as nearly 3.5, backed off a little bit to 3.2, but the 10-year note is up a ton. Bitcoin cracked as low as 17,000 and change this weekend. Now it's hovering around 20K. Oil still above $100, which I have a feeling it's still going to stay above $100, but we could test it. You know, from the highs at 128, 129 back in March, we could see oil retest the $100 level, but I think it's going to remain pretty supported, and a lot of important decisions to be made. The difficulty in trying to find great stocks. I mean, here's year to date. This is year to date sectors. This was last week, by the way. This was up around 50 some percent. Like year to date, energy was up 51%. Now it's 32.41. So we had a massive correction in energy just in the sector alone last week. If you were watching energy stocks, you saw that there were some big corrections, big sell-offs as oil dropped from 123 down to 110, 107. So we've seen some pretty severe sell-offs in a lot of those energy stocks, probably some heavy profit taking. Year to date, with the markets in bear market territory, everything is in red. Energy was that kind of one sector, that one shining sector that was showing some promise, but things are pretty difficult. However, it's good to be trading other asset classes. Forex has been pretty solid, very volatile. Lots of opportunities out there for some movements, and hopefully traders are taking advantage of it. So last week was a pretty solid week. This was a couple things I want to talk about today. So last week, pretty decent. End up generating around 2,200 pips last week, which I'm not complaining, of course. And we'll continue to just grind out some good pips and take advantage of volatility in Forex. I want to talk about this. So I showed this chart probably a month ago because we were looking at I think the 6th or 7th worst start in the S&P 500. I think it was 6th or 7th ranked, and that was in the first 90 days of trading. And then it proceeded to show, from 91 days to the end of the year, how did it perform? And I was trying to make some sense of it and look ahead to see how the market would possibly battle back this year, which would be we may have a rough start and then we battle back, and the market finishes essentially where it started, and we have a big range to trade for the rest of the year. Well, fast forward to now, we're at the 115-day mark for the year, and we're now in the third worst start in history of the S&P 500. So where do we go from this point, day 116 to the end of the year? We don't know yet. How about the end of the year? We don't know yet. Okay, so what I looked at was, okay, so 1962 was worse, and 1932 was worse, right? 1962, we started off negative 24.1%, which we're nearly there right now. But end of year, so we started off 24.1% in the hole, finished 11.8% in the hole. So we did not finish positive on the year for either one of those previous worst starts. So what I did is I went back and found the S&P 500 previous years, 1962 and 1932. So there's 1932, there's 1962, and I wanted to see, okay, let's say we have a horrible year in 2022. What is 2023 potentially going to look like? Well, in 1932, with that terrible year, we bounced back aggressively, 46.59%, had a stall year, and then another really nice run. I mean, look at this run from 1933 forward. From 33 to 38, we had big returns. So, in fact, I'm curious, like over the next 5 years, again, this does not mean this is going to happen, but if you had 46.59 minus 5.94, actually, yeah, that's right, minus 5.94 plus 41.37 plus 27.92 minus 38.59 plus 25.21. All right, so that was over 1, 2, 3, 4, 5, 6 years. So divided by 6. So after one of the worst starts in the S&P 500 history, you average 16.09% over the next 1, 2, 3, 4, 5, 6 years. It's not too bad. So can we, have a bad year in 2022, and can we find a way to carve out gains moving forward? It's possible. 16.09% in the 30s. Now again, that's post Great Depression. So I'm sure that after 3 or 4 terrible years, which there were, 29 through 32 were horrible years in the stock market, and then 33 through 38 at least shows some resiliency and some fight back. 62, horrible year in the stock market. That's where it finished, 11.81% in the hole. I want to see how they bounced back. So 18.89 plus 12.97 plus 9.06 minus 13.09 plus 20.09 66, 11.36 plus 0.10 plus 10.79. This seems a little bit more realistic as the market matures. 1, 2, 3, 4, 5, 6, 7, 8, 9 divided by 9. So 55 divided by 9 is going to be around 6%. 6.12% over the next 1, 2, 3, 4, 5, 6, 7, 8, 9 years. Okay. Better than zero, I will say that. So anyway, this is what I kind of ascertained from this chart. Third worst start in the S&P 500 in history. How do we finish the year? We don't know. How do we go from now to the end of the year? We don't know. But if history shows us anything over the last nearly 100 years, it's going to be hard to finish positive. Okay. Now, do we have the mechanisms in place to rally and show growth? Sure. If you looked at the last 14 years, we artificially engineered a lot of growth and propped up assets. But I think right now it is a very anti-growth world, as everyone is just kind of bracing for how do we get out of inflation? How do we lower inflation? And it just hit me last week as the markets were selling off that we're also getting into the end of the quarter. So June is end of Q2, and that's certainly going to have an impact on, possibly summer volatility. So here is the E-mini futures, right? So S&P E-mini futures getting a full price feed. This is a monthly time frame. Pre-COVID high back in February, March of 2020. Could we be sliding down to it? It's very possible. Let's go to the weekly chart. Okay. And this is the one thing that's a little concerning. Does everybody notice here that on the weekly time frame, we closed right here? We closed below that 38% fib. So if you have this low, you have this high, and we close below that Fibonacci level. That brings the next one into play. The 50 to the 618. Now again, 50 is technically not a Fibonacci level, but it is the equilibrium of the market. So can we find that 50% correction? Sure. By the way, if you think back to 2008, 2009, the peak to trough move in 2008 to 2009 was 57%. So if we get a 50% pullback, that's significant, especially considering we're all-time highs. That is how some of these big hedge funds have been, losing their butts. Tiger Global Management, I use them because they were talked about last week. 52% down for the year, and they're a multi-billion-dollar hedge fund. So anyway, look, there's ways to trade it. I don't want you to see like all the news. Look, we know that inflation is dominating the headlines. We know the markets are red. I know that people are concerned out there, but there are ways to trade it. All right, time in the market, surviving the markets, being able to follow the flow. Hopefully, this is what we don't see. Hopefully, the reds don't continue to get bigger, and hopefully, the one shining light and energy and having some sector to play is not going to continue to give back gains and have this reversion to the mean. If at the end of the day, energy gives back a lot of its gains because it's volatile and the other sectors continue to underperform, it's going to be tough to really find any gains in equities. Now, the good thing is we can trade options, so we have ways to trade without taking ownership. We have ways to trade and generate income. We also have ways to lower our costs on the stocks we do have in case there are any bumps. Because as we roll into July and get into Q3, there's going to be a new round of earnings, and we'll see if earnings continue to, give up, uplift the markets, so to speak. And then in Forex, we continue to trade. Volatility has been really solid in Forex. So let's take a look at things. Dollar index. This is a weekly time frame. We're back up towards the COVID highs in 2020. Are we going to break and go higher in the dollar? From a technical standpoint, think not yet. Okay, I think not yet. I'm looking for some highs and lows to form. Here's dollar index right here on the weekly time frame. One of my favorite prints here, indicator wise, we're back up to the tops. Overbought conditions with divergence on a weekly time frame doesn't happen very often. In fact, the last time that I saw this print was back here in 2015. So we printed there briefly, we printed there, we formed some consolidation. Okay, we've been in a range for the last 7 years. So the fact that we printed up here again, I like the indicator enough, and I like conditions on the higher time frame that I think we're going to see some weakness in the dollar. Now, in order to get that weakness in the dollar, I don't know what that looks like. Do we need to see a rally in the stock market? Possibly. Do we need to see that this could be a 3-drive pattern? 1, 2, 3, 4, 5. We could have another push to the upside and then have a corrective wave coming. So I'm not calling the top. I have not been calling the top, and I refuse to call the top. So I think we wait for clean confirmation. If this dollar is going to break, I'm watching price action here near the highs. If we start to break below this trend line, I'm looking for at least a 3-wave correction to come back into past resistance becoming support. We had this big breakout cycle back here back in November of last year into the new year. So we could fall into about 12,300 or so, and then the dollar is going to make a decision, long-term bullish or give back the gains and return back to range lows. But at the very least, I'm focused on this right now, actively looking for some weakness in the dollar in the near term. Okay, traders on my flex room know that. We're pursuing that. We took some profit last week. Pound dollar, euro dollar had some nice non-FIFO profits. Looking for New Zealand dollar to find some pockets. Dollar CAD in a range. Dollar Swiss with the Swiss National Bank last week reducing the negative interest rate from negative 0.75 to negative 0.25. The Swiss franc is continued to be one of the stronger currencies in Forex. So I'm personally like fading that move. I think that we're going to find some good levels. I'm ultimately going to buy, dollar Swiss long again. I'm euro Swiss long, pound Swiss long, and I'm Swiss yen short. So I'm trying to navigate that in the coming weeks. DXY, dollar index with more data. Same thing here. Overbought conditions, looking for some confirmation to start breaking. If we can start heading lower, preferably break a trendline challenge to low, lower high, lower low. Fall back into some EMA clusters, fall back into previous resistance becoming support. That could be around 98, all the way potentially down here towards 95.77. Not a radio station, DXY levels. Okay, oil. Oil at 109.61. So oil did drop over 20% in the last 2 weeks. We had highs around 123. We've dropped around 11. Did I say 20%? I was exaggerating. Nearly 12% high to low for the last couple of weeks. So I think I was looking at 20+% if we came back down to the lows around 95. So if we drop from here back down to range lows, if we found this 144 and 200 EMA cluster, that would be about the 20% correction on oil. Okay. Now I do think that oil is still somewhat resilient. We find that low, we find this high. I could see oil, selling off, finding some lows, and then rallying back up. So I'm not super bearish on oil for right now. I'm just not. I think that we're going to have some bounces, but finding some support, $100 down to possibly 95. I think oil looks pretty good from there. Gold and silver, we have to watch the dollar. Holding pretty nicely. Gold is pretty straightforward. If the dollar weakens, if the dollar gets weaker, gold will get stronger. So I'm favoring, technically, I'm favoring some gold strength to at least get us back in the 1900, possibly higher. But that's what I'm looking for. XAG, silver, same thing. Silver doesn't quite have the uptrend line support, but silver does have some really strong support here around $19.52. Again, if dollar weakens, silver should be holding these lows and hopefully making its way back up to probably around $24. And if we're talking full-on recession, silver tends to perform pretty well. I would like to see silver get back up into the high 20s. But in order to get that, maybe I have to buy it lower, between $20 and $19. All right, crypto. Everyone's so scared to look at crypto now. Bitcoin's at 20,475. I see the conditions here that are signaling some really strong oversold conditions. Doesn't mean that the bottom is in. Left side of the trend line, right side of the trend line. This is what it's come to. I like the round numbers. I did add some set at 20,000. I was able to take a little stab and add a little dollar cost average position in. 15,000 is the next level. If we don't hit 15, I'm not adding anything else. If we get on the right-hand side of the trend line, I will think about adding more. But really what I need to see is the proof that we can hold and break. And maybe it's time. We've had this really strong move to the downside, really strong move to the downside. If the stock market continues to show vulnerability to the downside, I don't see Bitcoin going up at all. This is very correlated right now with risk on trading, and we're getting risk off in stocks and equities, and therefore we're getting risk off in crypto. And it doesn't help that pretty much everyone in crypto is cutting jobs or not allowing withdrawals. Like Binance started to lock down withdrawals, and Celsius is going essentially belly up, it sounds like. So there's some cleansing going on in cryptos, to say the least. But reason I still like Bitcoin, Ethereum is mostly the play for the network, blockchain, Web 3.0, more so than just a cryptocurrency. I don't know. I mean, we know that the speculation, I've said from literally day one of any investments on crypto, that if you're willing to risk everything you put into it, if you're comfortable with that, that's the risk. Because the asymmetrical upside is super encouraging and optimistic, but you got to be willing to risk it in case this thing goes to zero, right? So we'll find out, but left side of the trend line is where we are. It's trading in a risk-off environment. It's hard to get this thing to bottom for right now. 20,000 is that 2017 high, though. So past resistance becoming support makes sense. We could have some relief rallies coming on Bitcoin, but if we don't break this trend line, I'm still not as excited. All right. We can take a look at some currencies. You have any requests? Go ahead and type them in. Nice to see everybody. Daniel crushing it. Currently at 5,736 pips for the month. Swiss yen. Yeah, Swiss yen's being a turd. I know that. There are some really interesting. I had a podcast over the weekend. I've told my traders about it in the Flex Trading Room and Equities on Demand. In Search of Green Marbles with Weiss Capital Management Group, Lundy Wright and Jordy Visser and their host. Anyway, great podcast. I listened to over the weekend. They were actually talking about the Bank of Japan and kind of some of the big institutional bets being made against the Bank of Japan, thinking that what they are doing right now is completely unsustainable. Again, one of the silliest things to do as a trader is trying to fight a central bank. Do not fight the Fed. Do not fight the Bank of Japan. They will be harsh lessons because, I'm sure a central bank can, they will remain solvent longer than we, the trader, can remain irrational if the market's going in that direction. But we're looking at some potential breaking points on, the Bank of Japan and how much they've weakened their currency compared to what the overall markets are pricing it, bond-wise especially. So Swiss yen is at new historical highs. We've broken these 20-plus year highs from the monthly time frame. Okay, so I talked about this last week. If we look at, let me go to a cleaner chart here so I don't have these trend lines. Swiss yen. We talked about this on Thursday and Friday last week. So here's the weekly time frame, right? So I realized that the weekly time frame all the way back up towards these highs, which were in 2015 when the Swiss National Bank had their little flash crash debacle, and then we saw instant retracement back into some pockets. Now, if I fast forward in this area, well, look, we might be in open spaces, right? We may be in some open spaces on Swiss yen. I am surprised. Let me go to the weekly time frame. Did we print over? We did. So we did print overbought conditions with divergence, which I'm happy to see. I told traders this last week. With the location of the Swiss yen on the weekly, on the daily, on the monthly, I really have to wait and see where this ends. I mean, we're not that far away from ending Q2, right? We have this full trading week to the 24th, and then next week we're going to end on Thursday and kick off July on Friday. So I'm wondering, what does the weekly candle look like by this week? Well, it closed higher, but it printed overbought conditions with divergence, which again, technically I like seeing that. If we get into this week, is it another painful week of more weakness in the JPY? I don't know. Is it more risk-off trading because the stock market slides lower because we had the 50% Fibonacci? Maybe. So if the JPY gets stronger on risk-off trading, let's see how that translates into this Swiss yen possibly coming back down into a normal correction. I think if we're sitting here near highs and we start forming tops, I think the Swiss yen's first order business to take out a low is going to be down here to 128 or lower, all the way back here to this level and this pocket around 127.50. So we could be looking at a massive topping pattern. And again, it has to start rolling over on the right-hand side first. So where this week ends, where this month ends, we could have a monthly candle that looks like this. Let me go to the monthly time frame. It could be a big bullish candle right now, and perhaps by the end of the month, which is in basically a week and a half, if this long monthly candle in this 1, 2, 3, 4, 5 candles in a row, if we end up finishing with a long indecision wick to the north, I can see a correction playing out from there going into Q3. But time will tell. So one thing I'm not doing is I'm not calling tops on some of these yen crosses. Dollar yen could also continue to push higher. We've had a lot of indecision around this 135 handle, dollar yen monthly. Crazy bullish since the lows here at 103. This thing is up 3,000 pips. 3,000 pips in the last year. The amount of depreciation in the yen is pretty unprecedented. That is a 30+% move on the dollar yen. That's wild. In the last, year? That's a lot. Okay, so where do we go? Well, we look left on the chart. This is a high back in 02. Does this mean anything? Does this resistance mean anything? Again, trying to draw some parallels to what we've seen in the past. Anytime we've seen these massive runs straight up and very, kind of irrational, we've at least seen some hesitation. Market runs up, some pause and some rationality, and then some rebalancing. Okay, market runs up aggressively, rebalances. Market runs up here, pauses, runs up, rebalances. Market runs down. Market runs down. Forex of any market moves up and down. So as much as it's like, well, hey, this is unprecedented times and these are different. Maybe it is. Maybe I'm totally wrong, and maybe this thing is the most bullish train that I've ever fought, and I could regret it every step of the way. But to go up 3,000 pips and have virtually no pullbacks, I'm at least believing that with overbought conditions, we're going to at least have some volatility. And volatility can also work in a technical fashion. So if we see volatility, I'm still looking for a correction to have this dollar yen, stall at these tops, work their way back down into past resistance, find these previous lows. Look, this dollar yen can pull back into 127.50, and then it can go to 150 for all I care. Right? It can fall back into this area and find this low, this high, find some equilibrium around 38 to 50%, and then go to the moon. But when we look at a chart that's going straight up for 3,000 pips, it's hard to think that it's going to keep going up another 1, 2, 3,000 pips. I think we get a pullback first. And we're at that stage where this high to this high with disagreement, overbought conditions. If we carve out some highs, I have a really high bar count on my daily 200 EMA as well. So again, Q2, trying to be patient, trying to line things up, and trying to stay the course. From a technical standpoint, trying to stay the course, which right now it's not easy. Okay? All right. So, Tom, appreciate that. Thanks, Donna. Everyone chiming in. Yep, if you'd hit that thumbs up button for me while we're talking, just make it easy, get out of the way. Helps support the channel. And again, the comments help too, right? So anyway, we'll figure it out. All right, that's dollar yen. So let me quickly run through. I know I have a pretty big list of stocks this week as well. So for Equities on Demand students, we will be reviewing quite a bit. A lot of them are repairs from last week. So some Forex pairs we'll be reviewing this week in the Flex Trading Room. And I did get assigned Alcoa, which I'm going to add in a covered call, GGB as well. Have to repair a lot more with some covered calls, which include Robinhood, Uber, Alibaba, I might lose this week if it stays above 106, which would be about an $8 to $9 share move. Pfizer, we'll get some love there. Hopefully KHC is another one. Should have KHC, Kraft Heinz in here. Yep. So KHC, Intel, GDRX, Delta Airlines. I did not take assignment on, but I am in a new credit spread trying to make up for that. Chewy, I'm in. So anyway, a lot of cover calls this week, and we'll be adding some either 624 or 624 7-1 expirations, and looking to see if we can collect some premium to lower those costs, and hopefully over the next couple weeks get some stocks called away. And then in Forex, let's just run through any news this week. I know we have a bunch of Fed speakers this week. So if I go into this week's trading, take a look at the economic calendar. Last week, things were pretty wild and crazy with the cash rate decision. The RBA did raise rates last week. No, that was the week before. This was last week. So we had, let's see here, retail sales in China, core retail sales in the U.S. were down. So the Fed raised rates 75 basis points. That was a big discussion on Wednesday. We had a fake out on Wednesday, dropped on Thursday, dropped on Friday. Aussie employment, Swiss National Bank surprised the market with that reduction in their negative interest rate. They're still negative, but not as much. And then there was a 9-0 unanimous decision for the Bank of England to raise rates another 25 basis points. We go into this week, and BOJ, by the way, Thursday, Friday, kind of kept things running, which was kind of unusual that they did this, after everything throughout the week that happened with the Fed. The BOJ is just kind of piggybacking off the Fed to be like, nope, we're still buying Japanese government bonds. We're still trying to weaken the currency. Going to this week's trading, we have a lot of speakers. Like I said, ECB speakers, FOMC speakers. They're going to talk about inflation. They're going to talk about, the rate hikes. Are we going to look at 50 basis points for July? We're rating 75 basis points July. CPI coming out of Canada, CPI coming out of the UK. These prints will be important to watch. I'm telling you right now, this CPI stuff on all these different countries, the market's going to want to be moving on CPI news, because that is the data that is going to show whether these central banks are doing the right thing to lower inflation, or see ticks in data that is supporting that we're moving on to lower inflation levels, or we have peak inflation behind us. CPI numbers are going to be important. So we have CAD CPI, we have UK or pound CPI this week. Fed Chair Powell is speaking. He's got a 2-day testimony, I think. Semi-annual monetary policy report before the Senate Banking Committee. All right. And then there's a lot of other Fed speakers there. PMI numbers out of the Eurozone. Powell speaking day 2. Bullard speaking. Sentiment report. So by the way, this University of Michigan Sentiment report, some of the lowest in history. Consumer sentiment is one of the lowest it's ever been. And if I'm not mistaken, this might be the lowest. 50.2 is one of the lowest prints we've ever had. At least I looked at this here. I mean, we have not been. I mean, it's been a horrible year. I mean, everyone's like so pessimistic. I mean, makes sense why. I mean, inflation is hitting everyone everywhere, right? So I mean, if we went back, I'm just scrolling through for fun. Maximum allowed. Oh, I can only go back to 2011. Even 2011, post Great Recession, we're starting to see the bottom in 2011 or 2009 coming off the lows. In the 60s, I see low 60s here, then creeping up higher. Yeah, I mean, it's been 60s, 70s, 80s. What's the highest level? Do we get over 100? We did print over 100 in 2017. 2018 printed high as well. And then it's just been a downward trend since 2020. And even worse now. So, Senate report, pretty pessimistic. Are we in for a relief rally this week? We'll find out. Like I said, I don't think there's really much to stop this move outside of, okay, so we have the high right here. Look, we can have a rally coming that gets faded back down. And that looks no different than the market from the top right here. High to low, correction pushes lower. Correction pushes lower. Correction pushes lower. So we can have a rally. But if the bulls cannot take out 4,200, this isn't a bull market, right? I mean, if we're going to draw some lines here, have a little channel, we've exceeded to the downside. Is this, an aggressive, is this a falling wedge? I don't know. I'm not going to speculate. I just think from the bigger picture, a correction is happening. Right now, the Fed, to tame inflation, is sacrificing growth. We know that. We are not going to have high growth in a high inflation environment. It doesn't work like that. One thing that was interesting about the podcast I was talking about, that In Search of Green Marbles, is looking back over these lost decades when we've had these crazy runs and bull markets that have then kind of popped. We tend to see a lot of slow growth type years or stagnant growth type years. And yeah, it's very difficult to have growth in a high inflation environment. And we're going to see if these central banks really can tame inflation, navigate a soft landing, which I think is very doubtful, you know. But we got to trade it. We've got to survive it, to say the least. If you're, Forex has been a great market to trade as this is going on, and we're trying to lower our cost basis and ride this out. What I have not this is a tough decision last week for me. Deciding not to take a bunch of assignments, right? In equities. I mean, it's easy to say, like, we had look the stocks I was in last week. I like all of them. I want to be in a bunch of these stocks. Okay, I want to be in more of them. So where it says right here losses, these are all stocks that I don't mind owning. But if I own more Pfizer at $50 and it drops to 45, drops to 40, drops to 35, I'm just sitting and tying up margin on a stock that doesn't want to go any higher. So I decided last week I was going to take some credit spread losses, which I did. I took about $9.19 of losses, but then we issued some repair trades with, future credit spreads in the next 1 to 2 months that hopefully make up for what we lost this week. In addition to that, I'm going to put a new Coinbase covered call in for this week and see if I can continue to repair it. I think I did that on Friday. I'll double check that in Schwab when I start the class at the top of the hour. But I'm going to continue to try to get some stocks called away. Kraft Heinz, Coinbase, maybe Pfizer are my three candidates right now. If I can see some stocks get called away, those three alone would probably give me close to $20 a share in profit. So if I lost $9 and I make $20, I'm back where I need to be with some extra margin to work with. And I'm just going to continue to work really hard with these credit spreads and get back into the stocks that I really like, and not just tie up all my margin and try to buy and hold and buy and hold. All right. So credit spreads are going to be my best friend over the next probably 1 to 2 months until I am more confident that a low is in place, until I'm more confident that we have some bullishness to actually, get us some rallies and reliefs. Right. Nice. My wife and I just closed on a tank of full gas last week. That's good. That's good. Hopefully it didn't require a HELOC loan to get that tank of gas. All right. Swiss yen, dollar yen, a year or more. I don't know about that. I think there's going to be enough volatility on the markets this year that I don't think we're waiting that long. I think volatility in the forex market is enough that we'll see those quick rebalancing. We'll see quick rebalancing. We'll see technical still play out. It might just be, rather than having a big correction in the dollar yen, it might be something that's maybe we see such high volatility that the yen drops, 300 pips, 500 pips in a day, or 2 or 3. Just higher volatility, and the corrections play out in that regard. We've seen the yen do that. We've had some big 200-300 pip days on the yen crosses, and then they turn around and do the opposite. I mean, we literally saw that last week. So as an example, CAD yen got to as low as 101.50. This low right here, 101.70 last week, and then it popped back up. So we've had some corrections. That's 107 down to 101. I mean, that's a 600 pip correction in a matter of days. Granted, it's bullish overall, but we've at least seen some corrections play out. So if the dollar yen can cooperate, we can see that too. Hopefully Swiss yen. I know Swiss yen's weird. It's two safe havens. The Bank of Japan stance versus the Swiss franc, very different right now. Swiss National Bank and BOJ are at very different levels when it comes to what they're doing with their interest rates. Okay. But hopefully, I know that traders in my flex room know this. The Euro Swiss is one of my big trades this year. I'm still bullish on this thing. And I know it sounds crazy, but this level of resistance with the pockets that were created last week, if this starts to rally back up to 103 and change, excellent. I'm hoping that it comes back up to 105. It's just, look, it's breaking some structure in here. I get it. It does have me a little concerned, right? Like this channel right in here. So we break. If we retest the channel, could we go back down to 100 or 1.00? Yes, we could. But we could also form a double bottom and have a big pattern off that to get back to 105. And there's two things. One is we either have support and resistance that will continue to trade, and 105 is that resistance, or if this is a double bottom where this low holds and this low holds, that double bottom gets us all the way back up towards 110. So either this becomes a profit level with a range top, or this thing breaks through for a double bottom, which will fulfill all the way back up here towards 110, which of course I would be super happy if that was a trade. But we're going to have to, kind of take this one step at a time, one phase at a time. This continues to be an ongoing trade back and forth. Okay. All right. Any other questions for me today? Any of the currencies? It'll be a busy week in Flex, busy week in equities on demand, lots of repairs in equities, trading stocks and options. We have some new traders coming into the room. If anybody is in here for this session, my Mondays and Fridays, my YouTube sessions, if you're in equities on demand, or you're coming in new for the first time, make sure you dive into that classroom material. You are going to learn those key lessons, learn how to trade the core strategy, which is basically a credit spread, what we do with those consequences, knowing both legs, strikes, expirations, how we play them. We've done really, really well. In fact, last week was one of the only weeks we've really decided to take some losses because I just can't justify putting more money into my stock account, taking more assignment, and then watching the stock market potentially crater more. So I just drew a line last week. I'm willing to take losses, make up for in the next couple of months. If stocks get called away, let's make some profits. And like I said, hopefully my candidates to get called away, Pfizer, Kraft Heinz, and Coinbase, possibly this week. Okay. And watching the dollar index, watching oil, watching gold and silver, watching crypto. We'll see where Bitcoin is at if we can stay firm above 20,000. If we make a quick jump above 20,000, that's pretty good to hold that level. We have some really nice short-term pockets at 26 and 27 and change with these aggressive sell-offs. We've got pockets all the way back to 37. But again, if it's not breaking a trend line, it's not confirming. So there's your Bitcoin levels. If this trend line doesn't break, I'm not super bullish. So waiting to see if we can hold these lows at 20K with that 2017 high. If we can break this trend line, start confirming, then we can start to see a little relief. But I'm sure that at this point, relief would be welcomed. I think traders and investors have been beat up enough. It's got everybody nervous. But what's going to be interesting is with consumer sentiment so low and outflows, right? Less money coming into these major ETFs, but outflows. If people are going into cash, again, cash is not a great position to be in because you are going to lose to inflation. However, equities right now is a worse place to be because the market is selling off like crazy, right? Bonds, pretty terrible place to be as well because yields are so low, you're compounding negative gains. So cash is the safety blanket, right? Cash is the seatbelt. Although you're still losing, you're losing, principal essentially. You're losing to inflation, but it's better than watching the low tide sinks all ships type feeling where it's like nothing is safe. So I get it. Cash is at least starting to show promise, but if inflation remains elevated, you're still going to lose. It's just not a fun environment. So I'd say that if whatever you have invested, that's why we trade options. That's why we're trying to lower our cost basis. Again, dollar cost averaging at 20+% correction levels, 25% correction levels, 30% correction levels on indices. It's not a bad way to be, buying some discounts. But we need to see the broader market recover before those indices start to creep higher. And the fact of the matter, the Dow Jones might creep into 20% as well. I showed that earlier this morning. So we're in pretty terrible spots. S&P is down over 20%, so we're in bear market territory. Nasdaq's down over 30%, deep bear market territory. Average bear market, by the way, is 37%, and the Dow creeping up towards 20% as well. So correction territory. Does the Dow get into bear market territory this week? We'll find out. How bad does it get? So again, I'm not here to paint this like doom and gloom picture. I'm here to tell you that I'm trying to trade this and trade my way out of it just like everybody else. Trying to be smart about it, trying not to just dump money at the problem. I mean, if the whole market's on fire, I'm not trying to throw money at it. Okay? What I'd rather do is wait to see if the fire starts to go out, then start figuring out how to put my money back in the market. And meanwhile, Forex is volatile, able to trade it, take some opportunities. I'm trading big time frames, small time frames, looking for some, weekly opportunities, and that's been doing pretty well. So we continue to trade. Yes? All right. Let's see. One-on-one. Uh, that's something I can arrange. I've done that back in the past. It's just one-on-one stuff. But I don't have a formal setup like that. That's a lot easier probably in the next month or two once I have my retirement advisor, my RIA, Series 65, 63. Once that's officially in, then I can do any of that stuff. So we'll stay in touch about that if you're interested. Yeah, we can arrange that. So, all right, everybody, I'm going to let you go. 18 minutes. I'll see Equities on Demand students at the top of the hour at 10 o'clock. We have our Equities on Demand Monday through Friday. If anybody's interested or watching this recording, if you'd like to join me, a couple ways you can. Free newsletter, pulverreport.com. If you go into systems and trading rooms, I do offer a $27 trial for an entire month. If you like to trade Forex with me, you can trial the Flex Trading Room. If you like to trade stocks and options with me, you can trial the Equities on Demand Trading Room. So click on those links there to learn more. Again, that's pulverreport.com, systems and trading rooms. And that's it. Flex Room Tuesday, Wednesday, Thursday. Equities on Demand Monday through Friday. Be back here on Friday at 9 a.m. to wrap up the week. Let's have a good week. Yeah, let's have a good week. Do our best as usual. Happy trading, lots of profits. All right. See you soon. Bye.